Hey guys, how you doing? Welcome back. What's all this we hear in the news about Silicon Valley Bank going under? What happened? How did that happen, and whose fault is it? Well, I'm here to have a little discussion with you, maybe a thought-provoking discussion, and I'll say right off the bat that I'm not dispensing any type of financial advice. That's not the point of this video. The point of this video is to let's talk about what actually happened and whose fault is it. And I'm going to be interested in your comments later after we have our little discussion. So in kind of a rudimentary general way, what happened with the Silicon Valley Bank thing? Well, they were a bank just like any other bank. They had a customer base that was mainly kind of high-flying tech companies, and they catered very specifically to a narrow band of investors, mainly Silicon Valley startups and those associated with those companies. They didn't have a broad base of customers like a lot of the other bigger banks, but they operated as a bank nevertheless. Now, just a couple of years ago, most of those internet startup companies were chugging along in their businesses, and the pandemic hit, and the Federal Reserve in the United States lowered interest rates, just like pretty much everywhere else in the world, lowered interest rates to close to 0%. So banks, like Silicon Valley Bank, that had customer deposits and cash and assets, had to decide, well, how do we invest this money? And how do we invest this money safely without risking our capital? They decided to buy bonds, but they couldn't buy short-term bonds because interest rates were almost zero, and they wouldn't be getting much of a return investing in 30-day or 90-day or 3 or 6 month bonds. So they bought longer-term bonds, treasury bills, 5 years, 6, 7, 8, 9, 10 years maybe. I didn't look at their financial statements, but generally longer term, where interest rates were a little bit higher. About 1.8, 2%. Remember in 2020? Did you look at your bank statements in 2020? How much interest you made on your bank account? Like almost nothing, right? But if you bought a 5-year treasury bill in 2020, short-term interest rates were almost zero, but if you locked your money in for 5 years, you could get, maybe 2%. Now, what Silicon Valley Bank did is they bought a lot. They put all their eggs in one basket, right? They put all of their assets into these longer-term, longer-term bonds so that they could get some money. And everything was fine. The money was invested. They were making close to 2% instead of almost zero. Customers were happy. Everything was going along fine. Well, fast forward a couple of years, and now all of a sudden the Federal Reserve is jacking interest rates up quickly. In just the last year, they've gone from the Fed overnight rate of 0% up to, what is it now, about 4.5%? Shooting! Skyrocketing rates. Now you can buy a 5-year bond you can get 4 or 5% now, not just 2% like Silicon Valley when they locked in 2 years ago. So the value of their investments that they locked in at 2% 2 years ago, now that interest rates are higher, the value of their investments have gone down. Right? Those same treasury bills that they bought 2 years ago are now yielding much higher, meaning the price has gone down because interest rates are higher now. So their portfolio of assets, which is all invested, like all their eggs in one basket, has gone down. Well, okay, that's okay if they just hold them until they mature. They're fine. They're safe investments. But wait a minute. The tech industry isn't doing as well anymore. And a lot of these tech companies and depositors of Silicon Valley Bank wanted to withdraw their money. People went to the bank and they wanted to withdraw their money. And Silicon Valley said, okay, well, we'll have to give you your money. Just a minute. We don't have enough cash on hand. We have to start selling those investments we made. But they've gone down. Well, that's okay. We'll just start selling them. And they had to start selling these safe mid to long-term treasury bonds that they owned at a loss. And it ended up being a significant loss because they invested billions in those bonds. Their whole portfolio, basically. I don't know the details. As investigations go on now, the details will come out. I'm just giving you kind of a general, colorful picture of what happened. So they had to start selling their assets in order to give their customers their money. So they had to take big losses. Well, then they were thinking, well, we don't want to keep taking these big losses. We need to raise money. Even though we have some of these this cash that's invested in these longer-term, mid-term bonds, we need to raise money. And they decided to try and raise money. Well, no one wanted to lend them any money. They couldn't raise money. And people started to panic. Everyone wanted to take their money out. As more and more people wanted to take their money out, they simply couldn't keep up with the withdrawals. There was the typical run on the bank. We don't have any more money. All the money's gone, nowhere to go. So now the federal government in the U.S. has come in and said, hold on here, hold on. They've taken control, and they've to stop a panic now, because companies that had deposits with the bank need that money in order to pay their staff. And there's a big ripple effect. If people can't get their money, they panic. It's time to panic. Sell! That's generally what happened. A little bit of colorful commentary there. But basically, they put all their eggs in one basket. Then the value of the stuff they invested in went down. Everyone wanted to withdraw their money quickly. They had to sell the stuff that had dropped in value. They were losing money. They couldn't cover the amount of withdrawals. And that's all she wrote. So the question is, how did it happen? How could that happen? Whose fault is it? Well, let's think about it. Is it the moron theory? Is it the theory of morons, guys? Because remember, the moron, you don't know what the moron theory is? The moron theory is that the average IQ of a human is 100. By definition, we've just said that the average IQ of a human is 100, which means half the people have an IQ higher than 100, and half the people have a IQ of lower than 100, which means, by definition, that half the population on Earth are morons. Okay? And if you take that demographic and you disperse them around, you can come to the conclusion that a lot of the people that work at financial institutions are morons. That's the moron theory. So is it the people that were running Silicon Valley Bank? Is it their fault? Is it the moron theory on display? They were stupid enough to not have a diverse portfolio, to not invest their money in many different assets, to not put all their eggs in one basket. They put their eggs in the one basket that would be hit hard if interest rates went up. Is it because the people that were running that bank are morons and they should be held accountable? It's their fault? That's number one option. What about this option? Number two, is it the state that should be regulating banks and morons? Should the state be protecting us from the morons in the world? Should there be regulations? Should there be specific regulations that say a bank needs to have this amount of cash as a percentage of their assets available for withdrawals, and a bank is not allowed to invest, put all their eggs in one basket? They must have a diverse portfolio. Should there be strict regulations for banks so that the state regulators can protect us from the possible morons that make mistakes? Are they at fault? But remember, it's possible that 50% of the people that work for the state are morons as well. So is it right to say it's their job to regulate the morons at the banks so that they're protecting the population, which is also half morons? There's too many morons. Okay, look, the third choice. Is it the Federal Reserve's fault? They're the ones that lowered interest rates to 0 in 2020 and now jacked them up to 4.5% in the last 8 months. Should they take some accountability? I mean, if they're going to play around with monetary policy and move interest rates around like they're playing with a yo-yo, woo, 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 don't you think that might result in some little ripples in the economy? Some anomalies? Some things might happen? Woo! Interest rate 0. Woo! Interest rates up. Or do you have to go right to the top, the federal governments of the world that worked with the central banks, that in 2020 decided that they needed to save us from the pandemic by lowering interest rates to 0. The central banks lowered interest rates to 0 so that the federal governments of the world could borrow money for free and spread it around like it grew on trees and flood the markets with liquidity in the name of saving us from the pandemic, causing inflation that we see now. Is it their fault? The central banks that lowered interest rates to zero and the federal governments that flooded the market with liquidity caused the inflation that we're experiencing now. And that's what caused the central banks to now raise interest rates. And that's what caused this bank's assets to drop. It was that series of events that led to what is happening right now. In hindsight, some would say that lowering interest rates to zero was a dumb move. Flooding the world with free money and liquidity was a dumb move, and the only people that really benefited from this were the ultra rich and the biggest companies on earth that could just leverage themselves and borrow money for free and expand and control even a bigger portion of the pie, and the federal governments of the world that were able to flood the markets with money for free because they orchestrated this zero interest rate environment so that they could issue bonds for zero and flood the markets with money to save us from impending doom. Do you think maybe it was a bad idea? Or, guys, I have a better theory, okay? I have a better theory. And it goes back to the moron theory. 50% of people are above 100 IQ and 50% of people are below 100 IQ. And it just may be possible to surmise that about half of the people that work in the financial sector, that work in the banking sector, and that work at governments may be morons. And maybe they're making all this stuff up as they go, and they have no clue what's going on. And they're playing with interest rates as if they're playing with a yo-yo, and they're spewing out money as if they're drunken sailors, and none of them is considering what effects that might have to the economy of the world as a whole. But at the end of the day, guys, it doesn't matter which moron you pick. It doesn't matter whose fault you think it is. Who pays? Who's going to pay? You and me. Taxpayers. We're going to bail them out. We're going to print more money, bail them out, spew more money out. At the end of the day, it's us. We're ready! We're ready! We're ready for another bailout!